Welcome to TheoTrade. This is Don Kaufman. Here we are, April 12th, 2017. You are watching the Theo Night video. First of all, we had another trading session where it felt like the S&Ps, of course, are trying to push a little bit lower. And really what I want to focus on right now is predominantly, first of all, the indices. Okay, so, the S&Ps, the Nasdaq, ultimately the Russell, and more importantly, what volatility indicators are dictating at this point. Again, you'll note in many of the recent videos that I've done that I've talked almost exclusively about major index products. I've tried to and intentionally tried to back away from individual equities, which number one are coming into earnings season, and number two are likely just to get battered around like pawns in the larger scheme of things. So what do I see in the S&P futures? All right, first and foremost, this up here, and I'm going to kind of elaborate a little bit by drawing on the screen. Right up here, okay, happens to be 23.49, and we've been mentioning this 23.49 level now pretty much ad nauseum. Well, we started there in the morning, we slipped off of it, and this is one of the first days we did not completely rally back, closing again the trading session right and around here, 23.43. Not exactly, a massive sell-off, but again, we've now pushed off that 23.49 level, at least for the time being. Is it disconcerting? Yeah, a little. Okay, closing under 23.45, I think really provides a little bit more boost to sell-side activity. Okay, moving along over here. Yesterday, the Russell had a nice and positive day. Today, getting whacked by almost 1.5% over here. Now, yeah, I'm always watching the Russell because the Russell just tends to be like a hyperactive version, if you will, of the S&Ps or the Nasdaq. More importantly, though, if you take a look at a longer duration chart on the Russell, it's just dead flat in a range. I mean, you can't even make this stuff up. I mean, the Russell has not really moved since roughly December 7th timeframe, where it came into this range above, okay, the 1350 level. Now, I would have to say, though, the Russell, again, it's only a few points away from this 1350 level, cresting below the 1350 level, which it has done a number of times back here, in early January. I think that starts to become a bit more pivotal, but we're watching, of course, a number of key index products to see if they're starting to break lower. So why are we watching all these products? Like, well, what are we looking for here? Okay, clearly, if you're not seeing this, okay, you haven't listened to too many videos. First of all, volatility in every way, shape, or form right now is screaming that something larger is going on. Okay, and I'm going to show you that here momentarily. So first of all, we'll take a look at the volatility futures, and I want to be very, very specific about this. The volatility future that I am looking at, okay, happens to be a little bit further duration. Now I'm selecting a 35-day volatility future, and they were once again bid up today. Now again, I just want to enunciate, there's a number of different volatility contracts. The April contract only has 7 days left, so I kind of I'll forego looking at that any longer because the April contract, okay, eventually will be in settlement with the VIX. What's more important now is coming out to, again, this May contract that's got 35 days left. And if you just look at the May contract, just open up any chart over here, you can see the explosive move again to the upside. Now, it's natural, if you look longer duration at this chart, it's very natural to see volatility look like it's decaying over time, because it does. The closer you come to the future, the less risk is apparent, okay? Well, right now, though, risk is exploding. And again, this most recent move is from a low of about 13 to where we're just shy of about 15 right now. And again, on a percentage basis, these are fairly drastic moves up in terms of volatility, okay? So, well, what does the marketplace really see, right? That's the question everybody has. I'm not entirely sure, but I never use one volatility indication. Okay, I'm not going to, rest on my laurels looking at one volatility indication. Over the last few days, we've been watching the VVIX. That's the volatility of the volatility index. Now, again, I'm going to explain what that actually means. It's the volatility of the volatility index. You're like, okay. And literally just a few days ago, that volatility was sitting in and around, the 80 region. It's now exploded over a very key threshold, not only 100 yesterday, but cracking into the 110 range today. Okay. What does it really mean? Well, I can tell you that in any recent history since the VVIX has been recorded, that getting above 110 has been rather dire for the S&P 500. I'm going to say that again. The VVIX getting above 110 has been dire for the S&P 500 since the inception of this VVIX. And you can take a look, for those of you unfamiliar with the VVIX, again, I'm going to explain exactly what it measures here momentarily, but go back to like a 5-year daily chart, okay, and recognize the VVIX, okay, the data only goes back, all right, about that far. There's not a tremendous amount of data. For example, if you were to pull up, for instance, like a 10-year monthly on here, you're going to see that the first data point, okay, is going to be in March of 2012. Nevertheless, right, pulling up again, and I'm going to snap back over here to a 5-year daily chart just to kind of enunciate a couple of volatility events along the way. And again, this is the VVIX, and I can, zoom in over here on specific volatility events, but let's tighten up the time frame a little bit and go to work. For those of you that have been around, been trading for a while, if you come right back in here where those crosshairs currently are, okay, that happens to be October 2014. This was like the Ebola trade, and the markets tanked pretty hard. The S&Ps were down hard at that time frame, and of course you can see not only the VVIX getting above the 110 level, okay, and that 110 level is right in this region, but it actually shot all the way to the 140 region. It was serious, okay. This was follow through to that sell side activity, okay. Here we go again. Bouts of volatility have always been met again with extremes in the VVIX. However, the VVIX very often will explode higher, okay, and it doesn't necessarily need to continue to go from here, and I'll mention that again in a moment. But for those of you kind of uninitiated again to some more volatility events over here, this happened to be coming into August 24th of 2015. That was a 7% down move in one trading session. But I just want you to see the VVIX was getting lit prior to it. Okay, so the VVIX was actually on top of it. In fact, if you look very specifically at this, there are actually currency manipulations going on in China even prior to this. Again, indications of risk came in the VVIX all the way back into July. China revaluing the currency then ultimately caused August 24th. Market turns around, volatility collapses back down. Now, here you have the VVIX back to like the 130. You have to recognize here, now we're starting to get into more recent history. This VVIX spiking all the way to 130, and again, getting above this key threshold of 110 is right at this level. This was coming in to the beginning of 2016, where the S&Ps tanked right down in this time frame. Okay, right down in this time frame, right here. That was the S&P at roughly 1800 at the exact same time frame. What I want to elaborate upon, though, is trade saw it coming. That's the whole key to this. Trade saw it coming. By that, I mean traders saw it. And by that, they move the VVIX. Okay, then we actually come in here. This is Brexit. Okay, everybody saw Brexit coming. Yeah? Did you go out and buy volatility on the VIX itself? Then you come in, obviously, to the elections. There was a couple of volatile days this summer. Every time the VVIX spiked like this, it was met with much more substantial sell-side activity. Okay? Does this say anything definitive? Is it screaming like, that's it, we're going to crash and burn over here? No. But I'm telling you right now, the probability of a major event in the S&P is, okay, you need to be on guard right now. Every trader, their spidey sense is pretty much going off, and we all see it. Now, again, we don't go off of ever just one indication out there. I'm going to bring some more indications here in just a moment. But the VVIX, as I said, I wanted to relate this very specifically. It's the VIX. And what it's measuring on the VIX, it's measuring, okay, the activity on the VIX options itself. So for those of you, again, kind of uninitiated in this, the VIX options trade a ton, right? These things traded almost 900,000 contracts today. Just to compare that, like, all right, it's the VIX, I get it, right? Look at the SPX. The SPX traded just over 1 million. So yeah, everybody knows the SPX, the most prolific product out there. Okay. Now the SPX trading 1 million contracts, you have to realize the SPX is a $2,344 product. These contracts are worth what? You know, inordinately larger than, of course, the VIX options, because the VIX options are on a product that's what? You know, 14, 15 bucks out there. Nevertheless, still some huge contract size in the VIX. And what the VVIX is actually measuring, it's measuring the 30-day volatility in the VIX. And right now, 30-day volatility in the VIX is the 75th percentile, meaning that the volatility of the volatility index itself, okay, is extraordinarily high right now. Okay, so what other signs are we seeing of risk coming in? So we mentioned the volatility futures. By the way, the volatility futures in the VIX, okay, are not only directly correlated, the VIX options are priced off of the volatility futures. So that's almost like, you know, completely and utterly redundant. Okay, the VVIX is, of course, related to the VIX. But you have to look at bonds. Okay, I cannot get off of bonds lately, because what does the bond market see that the rest of us are failing to see at this point? Okay, if you don't trust the VVIX, you don't trust the VIX, you don't trust the volatility futures, look at the bonds. There's been nothing but upside. Now, again, for those of you that tune in and day out, I've been, you know, adamant and very bullish on the bond market. I don't think interest rates are going to go up. I think interest rates are actually going to go down. Why? Because if the S&P sell off, they'll turn around and buy bonds. They turn around and buy bonds, it's going to take the interest rate back down. That's it. That's the entire conjecture for that. And I feel like, you know, everybody's like looking at the Fed. Oh, they're going to raise interest rates. The moment they talk about raising interest rates, they've done nothing but go down. The irony of that. Nevertheless, the bond market, it is lit to the upside over here. Getting above the 152 level was fairly pinnacle. And again, I'm going to zoom in over here. I'm going to take these bonds. I'm going to contract, adjust them, hit apply, hit OK. And I want you to see like that kind of pivotal level that we seem to have broken above at this point. And right there is kind of that pivotal level. You hit it once, twice, third time was the charm. No, 4 times. Well, we're there. We're cracking into the 153 and 15 handles. Okay, so again, almost every risk indication that you see on the screen out there, we've got markets throwing off signs of volatility. People everywhere, they're throwing off signs of volatility. I want to see something also very, very interesting here of efficiency of the marketplace. Okay, take a look at the spiders and where the spiders close. They closed down $1.03. All right, I just want to show you one last thing over here. They closed down $1.03. Okay. If you look at the Analyze tab, when we use what's called Think Back is giving us yesterday's close. Look at the expected move from yesterday. How crazy is that? The expected move from yesterday said that the spiders were supposed to move to the edge. Okay, this is the broader move was going to be about $1.02. I'm averaging it there, about $1.02. Actual move, I apologize, was $1.03 on the day. The exact same thing is true of the SPX. Okay, the efficiency out there is uncanny. Watch these products for the next couple of days. The reason I'm saying watch them, they had incredible efficiency today, but one more sign of volatility. Tomorrow's Thursday. Thursday, though, happens to have an expiration because markets are closed for Good Friday. Okay, look at what the spiders and the SPX are saying about risk tomorrow. They just got, and the reason I'm pointing this out, that risk just got bid up into the close over here. We're looking at about an $11 expected move in the SPX into tomorrow's trading session. To me, $11, it doesn't seem like enough with all these risk parameters firing off, but we want to see, are we actually going to close outside the expected move? If we do, you have to realize the larger signal that sends. If we close outside the expected move, what's the bigger picture? Markets are starting to break down. They're becoming less efficient. As soon as efficiency starts to die out, put your helmet on because we are going in. And that's one of the big takeaways and why I'm spending so much time on this. The VVIX is already saying, get under your desk, put your helmet on. I mean, it literally is saying just that. Get under the desk, put the helmet on. This thing gapped up huge today. If we start seeing, okay, efficiency breaking down in the SPX and the spiders, it's going to be all over but the crying. Think about it. Thanks, everybody, for joining us. Have a great evening. Bye-bye.